Good morning or good afternoon, and welcome to our webinar, Defining Your Risk Appetite in a Post-Pandemic Economy. Are you tightening, staying the course, or leaning in? Uh, my name is Jeff Rigsby, and I'm President and CEO of CB Resource. And before we get started, I do want to take this opportunity to thank you all for taking time out of your busy schedule to join us. I know how challenging that could be these days, and we certainly appreciate it. We also mentioned that this session will run about 45 minutes, and I certainly intend to honor that commitment. And for those of you that may not be familiar with CB Resource, just to let you know, we are the performance management group of a national full service broker dealer. We are based in Irvine, California, and we deliver three what I would characterize industry leading solutions in the community bank space, and that's enterprise risk management, strategic, and capital planning. And with that said, let's go ahead and move forward. Hey, before we get started, just a few things. Just to get the most out of the webinar, just to let you know, we do have instant messaging capabilities. So to the extent you want to ask a question during the course of the session, you're certainly welcome to do that using that feature. We will also have a Q&A session at the conclusion of the presentation. Also want to mention the fact I view this as kind of a working session. So I hope you have a pen and paper handy as it relates to developing your risk appetite and the practices associated with that. All of our presentation material is available, so just let us know vis-a-vis email or a call. And we will also be recording this session as well, so that is available. Okay, as far as today's purpose, pretty straightforward. I hope you come away with learning a useful process to assist you with developing your bank's risk appetite. And I'd like to emphasize in good times and bad, because if you think about risk appetite, like strategy, it's dynamic, right? And in the best of times, we may want to, push the envelope a little bit and really go hard at getting more than our fair share. And perhaps in tougher times, we may recalibrate. So the important thing when you look at your risk appetite is understanding it is dynamic, and it should reflect and be in lockstep with your strategy. Just a quick overview of what we'll be covering in today's session. We are talking about the pandemic environment, so we'll just do a quick flyover and take a look at what we believe to be the pandemic economic impact and considerations associated with that. From there, we will define what risk appetite is, just to make sure we're all on the same page. And with that definition, I'll also walk through some of the key components that go with your risk appetite, if you will. From there, it's a working session, right? We want to walk through a process that can assist you with building your risk appetite framework, and that comes in the form of a heat map and statements. And we'll walk through key risk categories and just how we're going to do that. We're going to talk about, once you've got your risk appetite statement or heat map and statement in place, how do you assess and how do you measure where you are within that risk tolerance range, if you will? And we'll help you figure that out as well. And we'll go with some closing thoughts and have a Q&A session. So a quick word about the post-pandemic environment. Let's get back to slide one. Needless to say, I don't think we need to spend a lot of time on this, but just to reach some degree of concurrence, the pandemic has dealt quite a blow to both our national and global economy. And what's kind of gratifying right now is we're starting to see our way forward and see our way through it. But there's no question the world's a different place due to what's happened over the last 12 to 15 months. When we start looking at just behavioral, I like looking at kind of big banks sometimes to see what their behaviors are as I look at economic movement. And though I will acknowledge during 2020, many of the large banks started implementing CECL. But even with that said, if we just take a look at what the big three guys were doing over the last, say 4 quarters, and I looked at starting with Q3 of 2019 through Q3 of 2020, and I was looking at ALLL levels. And without getting too drawn into this, if you look at a 20-year history, you could almost follow how the big banks Reserve to determine what they view the economy to be looking like. So just a quick nutshell is if you take a look at the big three, JP Morgan, Citi, and Wells, JP Morgan increased their loan loss reserves 133% over a 4-quarter period, literally going from about 13 billion to 30. So a material increase. Citi raised it about 115% and Wells about 103%. So though I recognize CECL was probably implemented in many of these cases and that might have influenced their numbers a little bit, let's not kid ourselves. If I took you back to the Great Recession, these guys tripled down on their loan loss reserves. So it's not a bad leading indicator for those of us in the community bank space to see what the big guys are doing. When we think about what's going on with just the overall economy from a GDP perspective, it just depends who you ask. You know, if you look at Moody's forecast, they're rather gloomy, both from a short-term and long-term standpoint. But if we look at what the Conference Board has to say, and I kind of like their work, their baseline forecast basically puts today's economy consistent with where we were in a pre-pandemic environment right around Q2 of this year. Their optimistic one starts around next month, and worst case is it's going to be a prolonged lower performing economy for as far out as you care to look. But here's, if I had to focus in on one big condition that's occurred due to the pandemic, it's really what it's done to our behavior. And there's no question, due to the lockdown environment we went in, the digital delivery, remote workforce, digital delivery business models have skyrocketed. If you're part of Amazon, Walmart, or Target Digital, these guys have accelerated their growth trajectory for those groups. You know, they are today where they thought it would take 5 years to get to. So what we definitely could say in this pandemic and now post-pandemic environment, the digitization, if you will, has changed our business model in many respects. It changes how our customers choose to interact with us. It changes how we deliver our services. It addresses kind of our workplace safety environment. And certainly many of you are now leveraging remote workforce. And the question is with all of this movement from a automated delivery mechanism, does that change the level of risk we're willing to take and how we pursue our business? Last couple of points that are just part and parcel to this whole environment is we're in a prolonged low interest rate environment. And though the market seems to be resisting Fed policy, Chairman Powell came out last week and said this thing's going to run tight, if you will, through 2023. And many will say, well, maybe 2022. And let's just see, if you've been tracking the 10-year over the last couple of weeks, it seems like the market might have a view of its own. But from a risk appetite standpoint, we just have to recognize in this prolonged low interest rate environment, does that influence the decisions we make on how we pursue making money and creating value for our banks? And just kind of a last component is there's just sector consequence that we're seeing in certain areas. So if your bank has a concentration or a focus on certain sectors, that can influence your risk appetite. If you're serving the hospitality industry or you have a large retail base, and back a little earlier this year, though, we've seen some recovery. If you're in the energies, oil and gas, these sectors are taking a hit. And what does that do? And how does that influence the level of risk you're willing to take today and as you go forward tomorrow? So if we kind of sum up and take a look at what's going on, and particularly from a community bank perspective, chances are there's still an opportunity. Credit's going to take a hit. But I think it's safe to say it's not as bad as what we thought it might have been. And we'll still see how that rolls out. But, when we take a look at things like hospitality, retail, and even transportation, Southwest came out, last week and said they're still looking at a 5-year course before they're back to pre-pandemic levels of travel. So from a standpoint in our credit portfolio, are we going to take it? Some more than others, maybe some not at all. One thing for sure, the pandemic has accelerated everything digital. So whether it's your workforce, whether it's how you serve your customers, whether it's what product selection you offer and how you offer it, the world's never going to be quite the same. And digitization is definitely accelerated. This low interest rate environment is going to make things kind of tough. You know, it's difficult when you take a look at the competitive levels in the market. I think for many of you, at least this is the word I'm getting, are seems to be as intense as ever. And so we're seeing this downward pressure on yields just to be competitive. And probably more concerning, and again, how it impacts your risk appetite, is the fact that we're starting to see B-rated borrowers getting A-level rates. And that's tough. That's when you start taking a look. It's still good credit. It's still not necessarily adverse impact to your portfolio, but just to retain, if not grow, we're probably making some tougher decisions that could be influenced by our risk appetite. And then just the last couple points, uncertainty is still abound, and again, that always messes with risk appetite. And one thing I will share, though, if big banks continue to tighten and cut costs, which is typically what they do, either in uncertain times or lower economic times, you know, you can take that as a potential opportunity, and that might mean your risk appetite is going to pick up a little bit and go after that space that bigger banks might be creating and either tightening their credits or even cutting costs, which in many cases is reduction in workforce. So that's kind of our environment. So let's get our head around just what risk appetite is. So simply stated, your risk appetite is the level of risk your bank's willing to take or accept to achieve your financial strategic goals and objectives, right? It's how you create value, how you make money, and what you're willing to do or not do. And what we're going to cover today is risk appetite by looking at it through a lens of key risk categories. So we're going to ask the question, what is our risk appetite for credit risk, interest rate risk, liquidity risk, operational risk, compliance risk, strategic risk, reputation risk? There are other categories that you can take a look at, and you could use different lenses, if you will. But this is a framework we're going to follow, and we're going to talk about it in terms of what is our risk appetite from low to high. And we can talk about 5 levels of risk. But this is basically what risk appetite is, what you're willing to do or not do to create value. And because we do so much work in enterprise risk management, and for those of you that have an enterprise risk management system in place, spend time with your risk appetite. Because if you really think about what risk appetite is, it's the mechanism you use to calibrate your risk management processes. In other words, if you have elevated risk or you choose to do more of something that increases your exposure to risk, then whatever your risk management system is, ERM or otherwise, it should reflect where that risk appetite is elevated and ensure the assessment process itself is up to the task. Because, you know, risk appetite is not about risk avoidance, right? It's about setting the level of risk you're willing to take so that you can ensure your controls are appropriate for that level. As far as the primary outputs, when you get into this process and you're working with your management team or your board, you really want to come away with 3 things, right? So first start with just reaching a level of agreement on what level of risk you're willing to take. And as we mentioned, from low to high. So the first output you want to generate in this exercise is the actual heat map. What am I willing to do or not do to create value and make money? And is that low? Is that low moderate? Is that moderate high? And bringing it back to kind of the lead in on the whole pandemic question is these are interesting times, right? Think about it a little bit. We're finding that banks are falling into 3 different categories. And this is during the pandemic and is probably as we roll into this post-pandemic environment. And many of you will fall into one of those 3 categories. You're either tightening, right? As we mentioned in the title of this webinar, you're either tightening, you may be staying the course. Tightening might just be able to say, hey, we're sector affected. We just want to weather this storm and we're going to batten down the hatches and live to fight another day. And some of you have read the tea leaves, say, you know, we can stay the course. Our earnings targets, our growth rates, everything we plan to do is still what we plan to do. And then there's a handful of you out there saying, hey, wait a minute. A bunch of people are hunkering down. Some are staying the course. I think I'm going to lean in. And I want more than my fair share. As a matter of fact, I want a material level more than my fair share. And when you think about those conditions, those can all be calibrated or determined as part of a process of developing your risk appetite. So back to the deliverables, risk appetite heat map, deliverable number 1, output number 2, your statement. So it's one thing to say you have a moderate level of risk appetite, or a moderate high or a low, whatever level you choose. But the rhetorical question is what the heck does that mean? So without a risk appetite statement to further define what level of risk you're willing to take, you're kind of at an incomplete point of your journey. You're further on than you want it, you may be, but not where you need to be. You need that risk appetite statement laid out, and I'll talk about that in a second. And then the third output is, once you've established what your risk appetite is and you've defined it, then what are those risk appetite thresholds or levels, if you will, or tolerance levels that indicate where you are across a risk spectrum? So spending some time to say, hey, these are the KRIs or KPIs I'm going to use to measure and monitor my risk appetite, and I'm going to figure out what they are low to high. And so this table to the right is just to grab an Excel spreadsheet, list what those KRIs or KPIs are, and determine what those levels or ranges should be in order for you to track the movement of risk as it relates to your risk appetite. As far as the steps to get this all done, before you start, cracking your heat map and starting to write stuff up, just understand your risk appetite already exists at your bank. Whether you've done a heat map or anything else, your strategic plan, if you've done a strategic plan, and most of you, or probably all of you have, it basically says what your risk appetite is. If you take a look at whatever your pro forma estimates are for growth, or for what your course of action is from a financial standpoint, or what your goals and objectives are, those are indicators of what level of risk you're willing to take. So the first step in the process is pull out that strategic plan and see if you can determine what that plan is telling you as it relates to the level of risk you're willing to take. So once you've got that out there, you want to establish that heat map, and we'll get into that process. From once you have that level of risk defined that you're willing to take, then you want to work on that risk appetite statement. And then lastly, you want to create a system or a dashboard, if you will, that allows you to track and measure how your risk is moving across tolerance levels. And that's pretty much the flow. Here's the big thing. It's when you're talking about risk appetite, what are the types of questions you're asking yourself to determine what level of risk you're taking? And there's some pretty standard, assumptions you can make when you go down this process. And here are 5. Here's just 5 basic places to start. The level of growth that you are willing to take or pursue has a certain level of risk associated with it. Some of you might be used to talking about growth from an inherent risk standpoint. The more you grow, the more the risk you're taking. But that's a truism. If you're trying to grow 20% a year, and the market's growing at a rate of about 5% a year, you want a 4x factor over market trends. Chances are for you to get there, you're going to have to take on more risk. So point number 1, the level of complexity of your business model is an indication of the level of risk you're willing to take. If you're very targeted, you have a non-complex product line, a non-complex balance sheet and income statement, and just very focused on high execution, there's a level of simplicity to that also reflects a controlled risk environment. But the more complex it gets, the level of customers you serve, the types of products you offer, the expansion into local, regional, national markets, leveraging a digital environment or partners, those are all levels of complexity that are a reflection of the level of risk you're willing to take and need to be considered. Think about your delivery channels alone. Are you a single delivery channel? You're a business bank and you have a bunch of business bankers. That's your model. But all of a sudden you say, well, we have a branch network. Yeah, we have an online bank. Well, we have these partners. Well, we're expanding and we're launching a whole digital bank thing we're doing. All of those elements are a reflection of your delivery channels. And with the expansion of those channels, suggest the level of risk you're willing to take or not take. Asset quality is one of those things that you guys kind of get, right? The more risk you take as it relates to quality influences the level of risk you're going to have to manage. And then lastly, concentrations. And concentrations, we're all used to talking about it from a credit standpoint. concentrations could exist on multiple levels. The stuff we're familiar with is credit, but you can have concentrations in your deposit portfolio and a dependence on large depositors. You can have market concentrations. You can have product concentrations, multiple scenarios, but each one of these factors need to be considered when you're developing your risk appetite. So just kind of thought as we get through this process, when you're building your risk appetite statements, you want to do two things. First off, just if you say your risk appetite is moderate, help me understand why. Just explain what the primary reasons are for your selection of that level of risk. And then secondly, I always think it's useful if you're telling somebody, and assume your reader is management team, workforce, board, regulators, whomever, let them know what your risk appetite is, describe it, and then do a brief description of your control systems. It's worthwhile, right? So if this is the level of risk I'm going to take, oh, by the way, this is how I control that risk. And that kind of gets you to your statement. So let's go ahead and, break out a piece of paper and let's work through each of the key risk categories and make this a working session for the balance of time we have together, and see if you can start assessing or gauging the level of risk you're willing to take. So let's start with credit. Okay, so now we've decided that there are certain characteristics to low to high risk, and you can also view this as, am I tightening, am I staying the course, am I leaning in? But let's talk about some common characteristics of a lower risk appetite. So if you have a lower risk appetite, chances are you have a relatively low appetite or a relatively low growth rate. And so that, and again, we're talking just about credit right now, but a low risk appetite would indicate kind of, the most you really want is what the market will give you. And you're comfortable with that, you're doing well with that, and that probably puts you to the left side of the scale. Your product offerings are probably pretty straightforward, pretty non-complex, and very clear underwriting and processing techniques for that portfolio. You probably are relatively diverse in that basic portfolio. Not a whole heck of a lot of concentration level there. Probably don't make a lot of exceptions. By the way, I'll pose a rhetorical question, and I need to go back for a second. Bear with me 1 second. I skipped over a slide. And so this is the flexibility when you're doing a webinar. But I usually don't get to this point of the discussion without making my one observation of this session. And I want you to think about this statement. I want you to think about all the executives you work with in your board and your management team. And I just want you to think about this, but just because you're really good at something doesn't mean you're not taking greater risk. It never ceases to amaze me when I hang out with my banker clients and friends, and they're just really good at something. And I'll cite it when we'll talk about credit, but let's just say you're a regional SBA lender. And there's some certain characteristics to regional SBA shops. They tend to run very lean on the funding side. Now, everybody, because of PPP, is sitting on a bunch of excess liquidity, but tend to be kind of lean on the funding. They tend to run elevated CRE concentrations, sometimes as high as 800 to 1,000%. And yet they're saying, you know what, we're really good at this, not feeling the risk. So all I'm here to say to all of you is, just because you've mastered something doesn't give you a pass on acknowledging it represents a significant amount of risk. And if you leave with this session with no other message, I want you to think about that. So with that, let's get back to credit. Kind of amazed me, I missed that. So we're talking about credit. So imagine, it's not really overly complex to figure out what a lower level of risk appetite looks like. A pretty much basic portfolio, basic delivery channel strategy, limited to no exceptions. And by the way, I'll ask one rhetorical question as we think about credit, and think about this when you're working with your team. Can you be conservative and have an above average appetite for risk? So just write that down somewhere. Can you be conservative in nature and have an above average appetite and risk? Short answer is yes. You can have super tight credit risk underwriting standards and want to grow 20% or more a year. It just means you're going to have to generate a lot more apps than the average bank because you're only going to accept a certain level of quality in order to fund that deal out. So you can be conservative and have an above average appetite for risk. But let's stay in with credit. So what does a higher appetite for risk? What does moderate, high start looking like? Well, I'll tell you right off the bat, if you have an above average appetite for growth, that kind of puts you to a moderate level there, meaning you want more than your fair share. You're willing to exert and take on more risk to gain a greater advantage in the market, more product, more growth. Now, as you look at the nature of your product mix or the complexity of your products, do you have multiple products serving multiple customers with unique and different characteristics? So the more complex of what you're doing, if you're a straight business bank and you've got a kind of a straightforward CRE program, a straightforward C&I program, and you're kind of operating within that channel, that's a relatively low, moderate level of risk appetite. All of a sudden you start layering on factoring or some other construction area considerations, or you start elevating your concentration levels. That's starting to lean your risk appetite towards the right. All right. So think about it. So if you have elevated concentrations, a significantly complex product offering, you might use exceptions, but you kind of mitigate it more than worrying about hard and fast rules. You're kind of the bank that says, you know what, I'll pick up a little more collateral. I'll improve my LTV position to offset cash flows. Those types of things still represent risk. Credit quality represents risk. Digital delivery or artificial intelligence represent risk. If you're working with partners, and many of you may be now from a fintech point of view, either to help you generate more business, or you're operating as a platform to serve that fintech partner from a lending perspective. Green River, if you're familiar with Green River at least has been the platform for Rocket Mortgage. So what level of credit risk are they taking on the loan side? And then are you local, regional, or national? What's the overall size of your market? So when you take those factors into consideration, you want to take a look at the table to the right and start asking yourself, you know, my risk appetite is X. So let's just use something that pushes your risk appetite up a little bit. So you might say, you know, my risk appetite is moderate high, primarily due to my above average double-digit growth rate, my willingness to run elevated CRE concentrations, my ongoing investment in expanding our digital delivery mechanisms, my dependence on third-party partners for business generation, and you can kind of get the gist, right? What is tipping the needle for you, and you fill in the blanks. Likewise, you can say, you know what, my credit risk appetite is low moderate, primarily due to the fact that, you know, I pursue market level growth. I have a non-complex business banking credit portfolio, and I exercise limited to no exceptions. That's pretty low risk appetite. So I hope you're getting the feel for just what factors you need to consider. So if you just capture these bullets and put low to high on next to each one of those bullets, you'll start formulating the level of risk you're willing to take. And then just as a footnote to the right, again, when you look at A, define what your risk appetite is, B, describe your control systems. You know, we're experienced, relationship-driven commercial lender. We control our credit risk by maintaining a qualified team, a comprehensive credit risk management program, the stability and experience of our leaders, you know, so you can kind of get a gist of, you know, build out what your controls look like. So that's credit. Let's take a quick look at interest rate risk. And again, I think we all know what lower risk looks like, right? Non-complex balance sheet. You kind of avoid exotic kind of investment strategies. You're not big on hedging. But what does elevated or increased risk look like, you know, from an interest rate risk or a market risk perspective? Many of you might just be willing to run a little higher on either the asset or liability sensitive side of things, and maybe mismatched. That indicates a willingness to do something that you're confident you can manage it, but you may be willing to pursue either non-traditional or higher risk investment or other earning asset strategies to optimize yields. You may be willing to leverage swaps or other derivative programs to also optimize yields or profitability. You may be willing to bet on the market. So for those of you with the financial discipline with us today and looking at how you manage the balance sheet, that could drive the level of risk you're willing to take. If you're primarily creating earning assets through a credit strategy of your loan mix, for a bank, that's probably the lowest interest rate risk component. So if you do two things from an interest rate standpoint, if you're super good at driving low cost relationship based DDA business, so you're funding your performance through low cost stable deposit products, and you have a relatively non-complex loan portfolio, and that's your earning asset side, your level of risk is on the lower side, right? But as you start looking at optimizing earning assets, and as you look at investment strategies and hedging strategies, and willing to make some decisions about where you think market is going to go, that's going to influence the level of risk you're taking. And I kind of defer to the financial management, folks in the group. But that is what tilts the level of risk you're willing to take from an interest rate or market risk perspective. Liquidity is kind of funny because of the pandemic and PPP. I'm sure that maybe a handful of you might have a kind of a funding challenge right now, but the industry is flush with liquidity right now. And if anything, it's kind of nerve-wracking because in a low interest rate environment and you've got excess funds and you've got to pay for that. It's not even that it's non-impacting. Your chances are you're paying for that money that you're not using. So anyway, when you think about risk appetite from a liquidity standpoint, again, I don't think I need to spend a lot of time on what lower risk looks like. But what does an increase, like what does moderate look like? Well, I'll tell you what, again, if you're leaning towards growth and you're leaning into some funding, moderate high starts looking at those banks that run a little hot, right? Your loan to deposit ratio is probably 90, 95, 100, 105, 110. Don't tell me you have a low moderate risk appetite. If you're willing to have 20% of your deposits in large deposit relationships, be they friends and family for some of our banks that are locally controlled and managed, or volatile deposit type relationships in the specialty deposit ranges where you're dealing with HOAs and nonprofits and escrows and title. If you're running larger concentrations, do not tell me you have a low moderate level of risk appetite. It's not the case. It's moderate high if you're allowing yourself to be dependent on concentrated sources of funding. And then, if you're looking at alternative funding, be it, broker deposits or other non-core sources, those things all focus or all reflect the level of risk you're willing to take from a funding scenario standpoint. But if you're running hot, if you have larger deposit concentrations, if you're leveraging non-core funding, all those things are fine. But please don't tell me it's low moderate. And depending on the level you're doing, it's moderate to moderate high. Now you'll have all the adequate controls in place, like a really sound contingency funding plan and all those other factors that mitigate your risk and bring your control levels where you want them to be. But the level of risk is still the level of risk. Operational risk is kind of a fun one. For the purposes of time, I'm going to integrate technology as a factor here. Again, if your risk appetite is relatively low, if you have a non-complex set of products, if your growth rate is relatively modest and stable, your employee workforce stable, minimal turnover, stable, just the right amount of technology to focus maybe on a little bit of automation for efficiency, a little better customer interaction, traditional branch network, M&A is a 4-letter word,
minimal level of partner exposure, yeah, your risk appetite operationally is probably low, moderate, low type of thing. But on the other hand, beyond organic growth, you want to acquire. You are acquiring. So if you're into an acquisition, you're looking at operation risk, please don't tell me that you think your risk appetite is moderate if you're attempting to acquire on an ongoing basis and you're dealing with systems integration, employment or employee integration, product integration, and just dealing with customer integration. Folks, that's not a low, moderate level of risk appetite. You're taking on more risk. The reason some banks don't do acquisition is because of risk. So just because you're good at it doesn't mean you're not taking on the risk. If you're open to non-traditional partnerships or product offerings, if you're doing large activity in the area of ACH and wire transfers, both in terms of level of transactions and dollar amounts, right? Number of transactions, dollar amounts. That's all an indicator of the level of risk you're taking. If you're adding employees lickety split because you're growing, that adds to the risk you're taking. So again, just recognize, and again, if technology is a non-negotiable for you from an operations standpoint, both in terms of how you manage your business, how you make decisions through AI, or how you deliver your products through a digital delivery strategy, these all influence and move you from that moderate, high range. Not that you can't control these risks and bringing your residual or risk controls in line, but it is an exercise of recognizing what you're willing to do. And there's a quick example here where I swiped one of our clients' risk appetite statements where they said our operational risk appetite is moderate to moderate high. When considering our desire to adopt technology solutions that enhance our client experience and improve efficiencies, we also are exposed to an increased level of risk associated with ACH wire volume and size and growing dependency on third-party providers. So in their mind, that was an indication. It put them between moderate, high. And by the way, for those of you that might be setting up payment rails and payment systems, that I think you know what level of risk you're taking, right? So that would influence your risk appetite. And as we look at compliance, pretty straightforward. Again, many of you might be just straight commercial banks, limited or no, retail business. So if you're kind of a pure commercial bank or business bank model, you probably fall on the lighter end of risk exposure from a compliance standpoint. You kind of have zero tolerance for regulatory risk exposure. But having said that, if you are fully into consumer-oriented products, so just for those of you that are a bank and trust or doing wealth management or doing mortgage lending, your compliance risk is not low moderate. If you're in the mortgage business, if you're helping people manage their assets or doing wealth management, there is a whole litany of consumer protection laws that you have exposed yourself to and are sensitive to. If you're in the mortgage business, you have protected classes that may not like your underwriting. So just recognize if you're in consumer sensitive businesses, then you're elevating your risk appetite from a compliance standpoint. If you're moving into new age, Bitcoin, cryptocurrency, or God forbid, cannabis, you're elevating your compliance risk profile. Not a bad deal. It can all be controlled. But don't kid yourself and say, hey, when it comes to regulatory risk, I tolerate zero risk. It's like, no, if you're going after these businesses, if you have MSBs, if you're banking a bunch of casinos, you're taking on more risk. And that should be captured in your risk appetite. Don't hide behind your controls. Articulate the level of risk you're looking at taking, and then put controls in place to bring that residual or that composite risk in line with what you're really willing to accept. But risk appetite is an opportunity to state what you're willing to do to create value. So again, compliance, a lot of times people take a pass and say, oh man, compliance, I have no tolerance for compliance risk. Well, the minute you opened your doors and let a consumer walk in, or let that company that leases warehouse space to cannabis companies in your door, or you've got that cash sensitive little convenience store that sells money orders and cashes checks, you've got elevated compliance risk. Okay, last couple of risks, and we'll bring this to to a halt. Strategy, pretty straightforward stuff, right? If you're looking to lean in times like this, you think that some of your competitors might be hunkering down or maybe not, a little conservative in this tougher post-pandemic economy. So, if you're taking a bigger bite out of the apple, you're leaning in, right? You're looking for growth, both organically or acquired. That should be reflected in your strategic risk appetite. If you're really leveraging technology and partnerships and really altering your business model, that should be captured in your risk appetite. And I'm sure it's in your strategic plan. If you're partnering with fintech firms to do some new stuff, one of my clients is one of the 6 banks that's going to be offering the checking product for Google Pay. Guess what? You're taking on some new risks that little regional or that little community bank didn't have before that agreement was signed, and that changes your strategy. Think about the legal risk you're taking on just entering into a bunch of fintech type of relationships. Who owns the customer? If that fintech bails on you and because they go partner with a bigger bank, did you put a big enough, payday in there for yourselves if they try to break it? These are, strategic questions in a new age of alternative delivery channels, digital delivery, third-party arrangements, fintech strategies. And are you willing to stretch your capital a little thinner to get where you want to go so you're driving up that return on average equity? These all reflect a willingness to take more than, say, an average level of risk or a moderate level of risk. And so the task of risk appetite, and what's so important is just, and I want to restate, be candid with yourself on the level of risk you're taking, because it's so much easier to establish your controls if you don't run from the risk you're willing to take and suggest it's not risk. And so I would reinforce that here. So again, if you're looking at average to below average growth, traditional business model, you're staying within your markets, within your customer base, you tend to like to have a little excess capital buffer in place. That kind of keeps you to the left of the moderate level. And then lastly, reputation risk. A lot of us think we don't take reputation risk, but again, I'll play more towards the higher risk. Is, if you're pursuing opportunities that elevate your reputation risk. So think about reputation risk from a stakeholder perspective, right? Your stakeholders are your investors, your customers, your employees, your regulators, your partners, and the communities you serve. Anytime you make a decision that might kind of cloud the issue with them, that's additional risk you're taking. So again, if you're doing a bunch of acquisitions, that elevates your reputation risk. If you're getting into higher compliance risk product offerings, that does elevate your risk with your regulators. So that's a reputation risk issue. If you're taking your bank public and you're now trading on NASDAQ, you now have elevated your reputation risk to the public markets. If you're increasing the level of third-party relationships you're having, you now have partner risk. So again, calibrate or adjust your risk appetite to reflect your behaviors. If you're staying left of what I just described, you kind of fall into that. By the way, I don't think anybody has a low risk appetite. You're in the risk business, bankers. So if anybody tells me I have a low risk appetite, I have a feeling that they're a credit union. And that's terrible to say, but most of you are at low moderate just when you open your doors, and it kind of goes from there. So let's see if we can just talk really fast about KPIs or KRIs. This is the grid you want to set up so that you can take a look at what are your key risk indicators, what are the risk thresholds or tolerance levels you're willing to take, and can you track them? This sets up your ability to track the risk appetite movement over time, right? And pretty straightforward. You probably have them in front of you, but and you can certainly tap on us if you want some free charts that help you guide that. Lastly, how does it come all together? Once you establish your risk appetite, you really have quantified what your strategic plan says, right? You've now said, this is what we're willing to do or not do to make money, and this is how we control it. And these are the 4 steps to follow to get there. And if you think about it, and if you have an ERM system, every ERM system is required to do 4 things, and that is to identify, measure, monitor, and control risk. The risk appetite's at the tip of the spear of that. So as you either expand your ERM system or adopt an ERM system or enhance it, putting risk appetite out in front of your ERM system makes the ERM system more responsive to the level of risk you're willing to take. Last key consideration, your risk appetite is your desired state. This says what you're willing to do. Your risk profile is your actual state. Real simple rule. Never allow your composite or residual risk to be higher than your risk appetite. And I'll say that again. Never allow your composite or your control structure to be higher than your risk appetite. So if you have a risk appetite like this that says, moderate high for credit, if this composite or residual risk is moderate, high, or high, that means your controls aren't adequate to absorb the level of risk you're willing to take. So you do want to bolt on a risk profile to make sure you're matching up. And that mechanism is useful, right? So that's the difference. Risk appetite, desired state. Risk profile, actual state. So I know I did a quick flyover, but let me leave you with some closing thoughts. Your risk appetite defines what your bank's willing to do or not do to make money, right, and create value. But, if you use it properly, and as you look at this post-pandemic environment, your risk appetite will tell you, are you one of those banks that are hunkering down, right? Are you tightening? And your risk appetite would probably articulate that. If you're staying the course, it's probably going to say that too. It might be in the more moderate range. If you're leaning in, and I know some of you on this call are, then your risk appetite should reflect that. And if it does, that means it positions you well to set up the control systems that are adequate to absorb that level of risk. Again, I'll close with a comment I might have made in the beginning. Setting up your risk appetite and putting on a control system, it's not about risk avoidance. It's about risk control. So if you appropriately define the level of risk you're willing to take, you're in the best position to control the level of risk you're taking, right? Risk appetite says, this is what I want to do. Your control systems say, okay, you can do it because we have the right controls in place. So I hope you found that useful. Before we go to Q&A, I just want to say that this is the business we're in, and our ERM solutions are modular, and meaning that to the extent you like pieces of what ERM does, our firm does that as well. We are a top-down C-suite targeted solution, but we have a full solution. But if you just looked at this risk appetite exercise that we just went through, and you just want to do that, that's something we do. And so you can look at ERM and take it one bite at a time, or you can adopt the whole solution. But just a quick advertisement for us, if this is something that you want to take to your organization, so you have a full solution in place that addresses the areas of sound enterprise risk management, which includes risk appetite, I hope you give us a call. And with that, just a reminder that this presentation is available. All you have to do is send us an email or give us a call, and we'll send it off to you, as well as the link. But any questions? Okay, well, great. I have some of you sending us, just knowledge, acknowledgments through the system on sending you our investment deck, or our presentation deck, and we'll do that. Okay, well, I noticed by the clock on the wall, I've run about 3 minutes long. If any of you would like to learn more about how you can develop your risk appetite, please don't hesitate to give us a call. Remember that developing your risk appetite and the overall risk management process of your bank is a journey, but in many cases it starts with better understanding your risk appetite and controlling the appetite you're willing to take. So with that, I'll leave you with that today. Thank you for taking time to join us on this webinar, and I hope you'll be interacting with us real soon. Thank you.